Hello, everyone. In this session, I'm going to discuss chapter number 6, and on your screen, I just uploaded my lecture notes. The title of chapter number 6 is a firm's production decisions and costs in the short run. So what I'm going to do, I will first review some of the topics from this chapter, and then I'll show you one or two examples that I have already included in your PowerPoint slides for chapter number 6. So the first topic that we should understand is the distinction or difference between a short run and a long run. So short run, by short run, don't get confused with this term short run. Short run does not associated with a period of time that is very short. 10 years could be a short run, and 5 months could also be a short run. So by definition, if at least one factor of production is fixed. So in chapter number 1, if you remember, we talked about 4 factors of production: labor, capital, land or natural resource, and enterprise. So in the short run, that is the time period where at least one factor of production is fixed. When I say it's fixed, I mean you cannot change. So for example, if the plant size is fixed and you cannot change that plant size in 3 years, then 3 years you cannot change your plant size. If you can change your plant size in 1 year, then 1 year is a long run. Less than 1 year is a short run. Then, of course, the long run then means that all factors of production are variable, or all inputs are variable, can change in that period of time. So for one farm, maybe 6 months is a long run. That is, within 6 months, or in 6 months, the farm can hire more workers, hire more capital, hire more natural resources, and also change everything. And that is long run. Then we have two different concepts of cost: explicit and implicit cost. What is explicit cost? Explicit cost is the cost that is actually paid out in money, in the form of currency. For example, wages are explicit costs because you are paying out of your pocket to workers. So that is basically explicit cost. Implicit cost is actually, it doesn't require an actual expenditure of money. And let me give you an example. Although this lecture is a bit old, that is why I wrote RDC. Actually, now it's RDP. So if I had not been teaching at RDP, Red Deer Polytechnic, let's assume I would have been running my own business and making $3,000 per month. So this $3,000 is my implicit cost. That is, cost of teaching at RDP is $3,000. I haven't received this $3,000. This is not out of pocket expenses or revenues, but this is my opportunity cost basically. Now, once you know the difference, and I'll solve one example for explicit and implicit costs, so don't worry. So accountants, when they calculate profit, they only consider explicit cost. So for accountants do not consider implicit costs. When they calculate their profit, they simply subtract all explicit costs from their total revenues and get accounting profit. Whereas economists consider both explicit and implicit costs when they calculate profit. Sunk cost is a concept that is basically a fixed cost. You can't retrieve your fixed cost, and therefore it's becoming sunk cost. Now, and I'll just show you how to calculate explicit cost, sorry, implicit cost, and how to calculate accounting profit and economic profit. The only difference between accounting profit and economic profit is implicit cost. Then we have a concept of normal profit. We have already discussed, I just mentioned, not discussed, I just mentioned economic profit. Economic profit is total revenue minus both explicit and implicit cost. That is economic profit. When your economic profit is equal to zero, this is called normal profit. So even if economic profit is zero, there is normal profit, which is equal to implicit cost. So I'll just give you an example, don't worry about it. What you need to know is economic profit is when you subtract both explicit and implicit costs from total revenue. When economic profit is equal to zero, it means the firm or sellers are making normal profit. So why not we just let me upload another file, and then I'll come back to this topic again. First, let me finish that topic, that is explicit cost, implicit cost, accounting profit, economic profit, and normal profit. Okay, normal profit means when economic profit equals zero. So let me open chapter number 6, and I've already uploaded on your course to your course website. Sorry, you can easily see the example there as well. So let me upload. Hold on, chapter number 6. So this is chapter 6. It will take a couple of seconds to upload the files. Please wait. So this is an example of explicit and implicit cost. Let me see. Hold on a second. Yeah. Okay. So you can see from this on this slide, total revenue, cash sales, excluding sales tax, is $20,000. So this is the revenue that the firm is receiving. Explicit cost. Explicit cost means out-of-pocket expenses. For example, rent, materials and supplies, utilities, hired labor, depreciation on equipment. So these are all different types of expenditures. When you add all these expenditures, this is called total explicit costs, which is 17,200. If you subtract this 17,200 from 20,000 total revenue, you will get an accounting profit of $2,000. So accounting profit in this example is 2,000. Okay. Now calculate economic profit. In order to calculate economic profit, you should calculate implicit cost. That is, if you were not running this business, how much would you be making in other activities? So this is given in this example. So let's take each component one by one. Number one, opportunity cost of 96,000 put into business, and labor input, labor put in by owners 4,000. Okay. Now, if you see this opportunity cost of $96,000 put into business, that is, the owner actually had already put this amount into this business, 96,000. This is not implicit. Remember, this is not implicit cost. Implicit cost is the opportunity cost of this $96,000. That is, if you had not invested this amount in your business, this own business, you would have invested in a saving account, right? Or you just would have kept your money in saving account or interest bearing account, and you must have been earning interest. So it says it is $800. You can easily calculate, although this information is missing, but you can easily calculate what is the interest rate. So if you put $96,000 and you are earning $800 a year, so you can calculate 800 divided by 96,000, right? $96,000. So this is equal to, and multiply by 100 in order to calculate percentage. So this is basically 0.83%. So basically, this is the amount that you are giving up in this business, not the whole $96,000. And labor put in by owners. Owners are also working, because if owners had not been working in this business, they must have been working some other place, and therefore they must have been earning, let's assume, $4,000. So 4,000 plus $800 is the implicit cost. If you subtract, if you add this explicit cost and this implicit cost, your total cost would be $22,000, and therefore your revenue is only 20,000. Sorry. So if you subtract 22,000 from 20,000, you have a loss of $2,000. So you don't have economic profit, you have economic loss of $2,000, but you have accounting profit of $2,000. So basically what you are earning $2,000 as accounting profit, but you are giving up you are giving up 2,000 in implicit cost, and that is why you are incurring a loss of I'm sorry why I kept saying 2,000. You are earning, accounting profit is 2,800. Your implicit cost is $4,800. So basically you have a loss of 2,000. So that loss is called economic loss. Why not let me give you another example, show you another example, and that will further clarify this. Let's see this. So I have already explained this, so I don't have to show you all this. This is another example, right? So first read this example, and then we calculate economic profit and accounting profit. So Abdi gave up a job that paid $1,500 a month to open up his own store. So now Abdi is opening up his own business, right? He's doing his own business, opening up his own store, and he just gave up his job, and he was earning $1,500 per month. He works full time in the store, which had a total revenue of $105,000 last year. So he made $105,000 total revenue. His total explicit costs only, that is out of pocket expenses, amounted to $65,000. He reckons his store is now worth $200,000. If he were to sell it and invest the proceeds, he would earn an 8% annual return. So he'll earn annual. So for example, he just sells his business and earn this $200,000 and invested, he will be earning 8% annual return. What is Abdi's economic profit during the year? Don't get confused. Don't include this 200,000 as your implicit cost. This is not your implicit cost. The earning on this 200 will be your implicit cost that you are giving up in order to run this business. So let me show you the how you calculate both implicit, explicit, accounting, and economic profit. So total revenue in the question, I've already given you the question as well, so you can read this as well. So 105,000 is total revenue. Total explicit cost, which is given 65,000. Now implicit cost. So first, Now he's not earning $1,500 per month. So for a whole year cost, 12 times 1,500, 18,000 you are giving up. That is your opportunity cost. That is your, not opportunity cost, that is your implicit cost. Then interest. So you are losing 8% on $200,000. So you are now giving up $16,000 because you are running this business. If you had not been running this business, you would have used that $200,000 and you would have been earning 16,000. So 16,000 will also be your implicit cost. So when you add all costs, that is explicit and implicit costs all together, your total cost would be $99,000. So your total economic profit would be $6,000. What is your accounting profit? It's simple. Although it's not shown here, but you can easily calculate accounting profit like this. Accounting profit is simply total revenue minus explicit cost. That's all. So your accounting profit would be $40,000. Okay, because $105,000 minus $65,000. So 100,000 minus 60,000, yeah, $40,000. And your economic profit is $6,000. Why? Because you have two implicit costs. If you add this, that would be 10, 20, $34,000 as well. So if you subtract $36 from $34,000, sorry, 34,000 from 40,000 accounting profit, you get 6,000 economic profit. Similarly, there is another example that you have to do your own. I have calculated accounting profit and economic profit. One thing I want to show you here, that even if the economic profit equal to zero, so suppose instead of 15,300 economic profit, suppose if this profit equal to zero. Even if economic profit is zero, it does not mean that you are not earning profit. You are actually earning economic profit. So firms will operate even if their economic profit is zero. Economic profit zero means that you are earning your opportunity cost. Are you getting my point? For example, let's say, suppose I'm working at RDP and or at RDP, okay, and suppose my annual income is, let's say, $40,000. So that is my income. If I had not been teaching at RDP, and suppose if I had been teaching in some other sector, I would have, suppose, been earning same $40,000. It means giving up job at RDP will not benefit me because I will still be earning same $40,000. So in that sense, my economic profit is zero, but still I am working at RDP. Why? Because I'm covering my opportunity cost. So if I'm covering my opportunity cost, it means I'm earning. Are you getting my point? For example, let me give you in this fashion. Give you another example. Suppose if I'm working at RDP and I'm earning $40,000 per annum, and if I had not been working there, suppose I would have been making $60,000 a year. That I'm not going to pursue that career. Why? Because my economic profit would be negative $20,000. Why? Because I'm earning 40,000. I could have earned 60,000. So that's a loss of $20,000. So negative economic profit. So even if my economic profit equals to zero, that is, my accounting profit is exactly equal to my implicit cost, then I will stay in that business because there's no point leaving that business. I will be earning the same money. So why I change my business? But if my economic profit is negative, then I'm not going to run the same business. Okay, so that's all. These are the examples. Make sure you understand. If not, you know my cell number. You know my. You can send me message through Blackboard messaging service. Let me go back to the lecture notes, chapter number 6. This. Let me open this. So now I'll quickly summarize. So only we talked about one topic, how to calculate accounting profit, that is total revenue minus explicit cost. Economic profit, that is total revenue minus explicit cost, that is out of pocket expenses, minus implicit cost. If economic profit equal to 0, it means normal profit. If economic profit is negative, you're not going to run that business. If economic profit is more than 0, that is called abnormal profit. That is, you are making money even greater than your implicit cost. Once you do this, then we come to a new topic, and that is theory of production. Now, what is theory of production? So in this production theory, we talk about different production levels of different, basically terms that we use in theory of production. First, as I said, theory of production means total production. So total product is total output. Okay, let me go back here. I'm sorry. Let me show you one more thing, and then I'll come back to this slide. And I apologize. I'm killing your time, but I want to show you one important thing, which I cannot draw diagram here on the screen. It's difficult. So let me go to this. Yeah. This is basically production. So see, you have inputs, and there are 4 types of inputs here. You have sand, gravel, cement, water, machine, and labor. So you have all these inputs, and you have to have a production process. When you process all these inputs, you will get total output, that is concrete. Okay, so cost of all these inputs is basically your cost of production, and then you process this either using labor intensive technology or capital intensive technology, and then you get final product, that is concrete. Okay, let me go back. I'm sorry, let me go back, and then I'll discuss. Here it is. So you have 3 types of or 3 basically terms that we use. Number 1, total product, that I just showed you, that you use all your inputs, and through the production process you will get total output. This is called total output, that is total level of production, total output. Then I have average productivity of any one of these factors of production. So let's assume labor. So average product of labor. From now on, I'm not going to say all the time labor. I'm assuming that I'm just taking labor only. So average productivity of labor is total productivity. Let me erase this so that you can read this. So total productivity of labor, and then divided by total labor. So total product divided by total labor. Now we have different names, right? So sometimes we call it total labor, sometimes we just write Q as output, total output. So total output, total product, Q, they are the same thing. And remember, in the bracket I wrote all factors of production are fixed except labor. So we are assuming that labor is the only variable input. All other factors of production are fixed. So factory size, plant size, sand, gravel, everything is fixed. Capital, everything is fixed. Only you can increase or decrease number of workers, that is labor. And that is why we are calculating average productivity of labor. The moment I said that all factors are fixed, this word fixed, it means I'm talking about short run. So this is short run. How do I know short run? In short run, you always have fixed factors of production. Not all of them, at least one. But in this example, I'm just assuming that labor is the only variable input. All other factors of production are fixed factors of production. So this is the average product of labor, and then we have marginal productivity of labor or marginal product of labor, same thing. Marginal product of labor is the change in total product divided by change in labor. This is the formula. Same as marginal utility in chapter number 5 that we discussed. Change in total utility divided by change in output Q. In that case, in chapter 5, that is marginal utility. That is when you consume one additional unit, what is the change in your total utility? Same concept. What is the change in total output when you hire one additional worker? That is marginal product. Sometimes we call marginal productivity. Same thing. Oops, sorry. Hold on a second. Let me make sure I did not miss anything. Yeah. Then I draw diagram that is also drawn in the slide as well. So I also showed in chapter number 5 how to draw total utility and then drive marginal utility from there. I'm doing the same thing here, but this time I'm adding average productivity of labor as well. So see, this is the relationship, and you have to understand this relationship in the next. No, I've already given you all these relationships here. So everything you have on your course website. Okay. Now look at these relationships. First, total product curve. See, here I have labor. Here I have total output. As you keep hiring more workers, output will definitely increase, but at a decreasing rate. So it increases, reaches a minimum, and then it starts decreasing. This is total product, always. And this is marginal product and average product. Look at the rule. The rule is that they both will start at the same point, always, always. Both will start at the same point. And then remember, whenever marginal productivity of labor is greater than average. So let me mark this so that you know what I'm talking about. Let me actually mark first marginal product. See this. This is marginal product line, right? So I'm just crossing this up to this point, this region, this whole portion. Now this portion has two components. One is increasing, the other one is decreasing, both. So marginal productivity of labor initially increases. Why? Because there are few labors and there are more machineries and equipments and other inputs. So labor is more productive. Reaches to this point. This is the maximum point, this, and then it starts decreasing. But I'm just considering that portion of the marginal productivity that lies above average productivity of labor curve. And notice that whenever marginal productivity of labor curve lies above the average productivity of labor, average productivity is increasing. You can see it is increasing. This is the rule. But I'm saying when marginal productivity is greater than APL. I'm not saying when marginal productivity is increasing. I'm saying greater, because it is increasing and decreasing also, but it's still greater than APL. APL is increasing. And when marginal productivity of labor is less than average productivity, that is lies below average productivity, APL must be decreasing. So that is the rule, always the rule, which I have written here. And one last thing, let me erase this and then show you. One thing, notice that the point of intersection between APL and MPL is this point. See this point? And notice that this point is at the maximum of APL. So marginal productivity of labor intersects average productivity of labor at its maximum. This is what I have already written here. Two important points to be noted. Number one, if APL is increasing, MPL must lie above APL. This is what I told you in a slightly different way. I said if MPL lies above APL, APL is increasing. So exactly the same thing, right? So see this. If your average productivity is increasing, your marginal productivity must be greater than average productivity. Or in other words, if marginal productivity is greater than average productivity must increase. Same. And opposite is also true. If APL is decreasing, marginal productivity must lie below APL. And marginal productivity of labor curve intersects APL at its maximum. Remember this. And also I already told you that this is a shortened analysis as labor is the only variable input. Now we explain law of diminishing marginal product, like law of diminishing marginal utility in chapter 5. Law of diminishing marginal product means that if you keep hiring workers on the fixed factors of production, capital and other factors of production, then a point is reached, right? Not right at the beginning, but a point is reached when marginal productivity of labor starts diminishing. I'm not using word decreasing, diminishing, or diminishes, or decreases, but we don't say decreases, we say diminishes. So this is law of diminishing marginal productivity. I can show you in the same diagram that diminishing marginal utility starts at this level of labor. When you hire more than this L star labor, look at this, marginal productivity start decreasing and then becomes even negative as well, like marginal utility. So this is all as far as production is concerned. So you have total product curve, you have average productivity of labor, you have marginal productivity of labor. You know how to calculate average productivity of labor. So the formula to calculate average productivity of labor is total product divided by labor, not output, labor. Similarly, marginal productivity of labor is change in total product divided by change in labor. That is, when you hire one additional worker, what is the increase in total output? That is marginal productivity of labor. And marginal productivity of labor after certain level of employment level, marginal productivity labor starts diminishing. This is called law of diminishing marginal productivity. Okay. Now we come to the cost, and cost in the short run, not in the long run. So in the short run, definitely you have fixed factors of production, you have variable factors of production. You cannot have all inputs as variable inputs, because this is by definition in the short run, you cannot change at least one factor of production. So you must have fixed cost, that is cost of fixed factors of production, and variable cost of variable factors of production. So these are all the definitions that you should know. Number one, total cost, we always write total cost as TC. This is total cost. Then total cost is equal to total fixed cost, TFC, plus total variable cost, TVC. Right? So this is TVC, total variable cost. So total cost has two components, total fixed cost, total variable cost. Then you have average total cost, like average product of labor. Now I have average total cost. What is average total cost? Total cost divided by output, Q, not labor. Remember this. When we calculate cost in terms of output. When we calculate productivity in terms of labor. So average cost is total cost divided by output. Similarly, average fixed cost is total fixed cost divided by output. Average variable cost is total variable cost divided by output. And therefore, same rule applies here as well. Fixed cost divided by output. Average variable cost is total variable cost divided by output. And therefore, same rule applies here as well. Average total cost must equal to total fixed cost plus, no, this is average fixed cost, and this is incorrect, average variable cost. Okay, so average total, let me write here, I'm sorry, average total cost equal to average fixed cost plus average variable cost. And then we have marginal cost, same as marginal productivity, same as marginal utility, that is change in total cost. You can see the formula, change in total cost divided by change in output, not labor, not change in labor, change in output. Or you can also calculate change in total variable cost divided by output. Same thing. Why same thing? Because total variable cost actually is responsible for the changes in the total cost, because fixed cost doesn't change. The cost of fixed inputs is fixed. There's no change. This is what I have written here, that as TFC, total fixed cost, is constant. So if I write change in total fixed cost, that is equal to 0. So there's no point writing this. Okay. Let me show you one thing, right? And for this, I have to open. Just give me a second. So I'm writing right like this. Total cost equals total fixed cost plus total variable cost. Then you have average total cost. Average total cost is average fixed cost plus average variable cost. Then you have marginal cost. So marginal cost is marginal fixed cost plus marginal variable cost. What is marginal cost? Marginal cost is change in total cost divided by change in output, equal to what is marginal fixed cost? Change in fixed cost divided by total fixed cost divided by change in output plus change in total variable cost divided by Q. But you know, fixed cost is total fixed cost. Fixed. It's not changing. So change is zero. So this whole term is zero. That is why I wrote that if you calculate marginal cost, so either you calculate using change in total cost divided by change in Q, or change in total variable cost divided by change in Q will give you the same answer. Okay. So that is why I can show you here. Let me go back here. I'm sorry. Hold on a second. Let me open that file again for you. Chapter 6. Here you go. So this is what I said at the end of this page, that marginal cost is change in total cost or change in total variable cost, because change in total fixed cost is zero. That's why we are not including. Now, how you are going to see the shapes of all these curves? So this is drawn here. So all these curves, and you have to go through. So this is total variable cost. If you add total fixed cost to total variable cost, you get total cost curve. Total fixed cost is fixed. That's why it's a horizontal line. Average fixed cost is continuously decreasing. Why? Because of this reason. So see, what is average fixed cost? Average fixed cost equal to total fixed cost divided by output. Output is increasing, but total fixed cost is a constant number. So the denominator is continuously increasing, and therefore this number is continuously decreasing. But it will never be equal to zero. It is very small number. And then you have all marginal and average curves. Right? Look at the relationship, and that is important, which I've already written down here. I don't have to read them all, but I can tell you two important characteristics, very important characteristics. Number one, marginal cost curve, this curve, will intersect both average variable cost and average total cost at its minimum. That is at this 2 point. Look at this. These 2 points are two minimums of ATC and AVC. Okay, always. Notice that ATC and AVC are getting closer to each other. Why? Because the gap between these two curves is average fixed cost, and I have already shown you here that average fixed cost is continuously decreasing. So the gap between these two curves, the gap between this curve and this curve is huge here. But as you increase output, you can see the gap is decreasing. The gap is shrinking. But they will never be equal to, they both are not equal to, they both are not equal basically. Why? Because average fixed cost will never be equal to zero. It's very, very small number, but it will not be equal to zero. Why? Because see, this is a mathematical property. If AVC equal to zero, it means this Q must be infinity. And infinity is not defined. What do you mean by your production is infinite? So that is not possible. So AFC will never be equal to zero. So these are different shapes of the cost curve. Same with the notice. Let me erase this and then I'll show you the last topic. Hopefully, so notice that whenever VC and ATC. So see this. Hold on. So see this. I'm just talking about AVC. The rule is same for ATC. When AVC is decreasing, this whole marginal cost curve lies below this curve. When AVC is increasing, the whole portion of the marginal cost curve is above the AVC curve. Exactly opposite of APL and MPL curve. Let me show you here so that you know what I'm talking about. See this curve? So these are exactly opposite of each other. One is average productivity of labor, marginal productivity of labor. The other one is average variable cost and marginal cost. They're exactly opposite. They're exactly opposite. So you know that law of diminishing marginal productivity starts at this level. If you remember, I told you, right? Because at this level of employment, marginal productivity starts decreasing. But you can also find out the marginal law of diminishing marginal productivity by looking at marginal cost curve. You can see at this level of marginal cost curve, which is the minimum, when you have diminishing marginal productivity, it means your marginal cost will increase. Your labor is less productive, and therefore you have to have more workers to get the job done, and therefore your cost will increase, additional cost, and that is, you can see the marginal cost is increasing. So they are the same thing in two different ways. So diminishing marginal productivity means either marginal productivity of labor is decreasing or marginal cost is increasing. So that's all as far as chapter number 6 is concerned. Please read, go through this chapter. But let me show you one last thing, and then I will stop recording. So let me go back to your chapter number 6 that you can find on your course website. So this is chapter number 6, and I'll show you one thing. So let's see here. So I've discussed this, this, accounting economic profit, normal profit, test your understanding. These are the 3 examples that I gave you to calculate economic profit and accounting profit. These are the 3 examples. You should be able to. Then I already discussed short run. Then we discussed total product, marginal product, average product, and this is theory of production. So you know how to calculate marginal product and average product. This, you have to see this example, and then theory of law of diminishing returns or law of diminishing marginal productivity, same thing. Law of diminishing marginal productivity or law of diminishing returns, same thing. Then this is test your understanding slide. So you should know how to calculate MPL and APL. If you don't understand, then you can always ask me. And then you have this all cost, which I discussed, and this is the example cost data, and this is the test your understanding slide. So here you can calculate total variable cost, marginal cost, average variable cost, and there's another, I guess, there's another test your understanding slide or not. Yeah, here it is. So this is test your understanding slide. Yeah, here it is. So this is test your understanding slide. Make sure you know how to calculate TVC, AVC, TFC, AFC, ATC, and MC. And one of the questions in your assignment will also ask you to calculate these numbers. Calculate. If you don't understand, just text me on my cell or send me a message through Blackboard messaging service, and we'll be more than happy to help you answer those questions. So thank you so much. Take care. Bye-bye.